With over 35 million people unemployed, businesses shut down around the country, and without really a timetable as to when or if things will ever get back to normal, the stock market seems to be bouncing back. A lot of people think that it's the Fed backstopping them and putting trillions of dollars of liquidity into the market, which it is. However, the Fed has issued us warnings about the stock market, and in this video, I'm going to explain what they're saying, what it means, and what we should be paying attention to. So stay tuned. All right, welcome back. If you're new to the channel, my name is Mark Moss. I like to talk about making money, investing money, having overall success in life. So if you like those topics, which I'm sure you do, click that like button, helps more people see the videos. Hit the subscribe button, hit the bell notification so you're notified whenever I put new videos out. Now, today we're talking about the markets. They've been going up, even though the economy seems to be crashing, but the stock markets are going back up. And really, we have to understand what the stock market is. And so the stock market, you may have heard before, it's called a discounting mechanism. And so that means that the market essentially discounts or takes into consideration all the available information that's out there, including present and potential future events. Now, when unexpected developments occur, then the market discounts this new information very rapidly. So, for example, when everything shut down because of the virus, all of a sudden the market crashed, knowing that with the company shut down, their future earnings were going to be written down. So the stock market crashed in advance in preparation, discounting in advance of that write down. Does that make sense? So as investors, we're always trying to figure out where the market's heading, right? We're trying to get in front of it. We're trying to front run it. And so I've been talking about in several videos about how the markets are broken. And what that means is that, the markets are supposed to move off of this fundamental data, like when earnings or prices change. But lately, the markets have been moving based off of the Fed, and the Fed's been pumping them full of liquidity. As a matter of fact, trillions of dollars of liquidity. And by doing that, they're not allowing the market to have this corrective market cycle that it needs to have. And just like anything, like a forest, eventually you need to have that forest fire to burn it down so you get the new growth. And business is no different. We end up with all these companies that need to die or at least need to be pruned back. And if they were pruned back like a rose bush, they could grow again. However, the Fed's not allowing that corrective market cycle. And so, of course, the Fed, the Federal Reserve, headed up by Chairman Jerome Powell, seems to be the force to watch, right? They seem to be the one that you want to bet with, right? If they're going to pump in trillions of dollars, then I want to be betting with them. And I've said it over and over and over that we don't want to bet against the Fed, right? They have way more money, way more power than we do. So we don't want to bet against them. But lately, we've been hearing a lot from Jerome Powell, Chairman Jerome Powell from the Federal Reserve, his other colleagues at the Federal Open Market Committee. And Jerome Powell spoke last Wednesday on a webinar for the Peterson Institute for International Economics. He also just appeared before America on CBS's 60 Minutes. This week, Powell's expected to testify on the CARES Act. He's supposed to testify about the CARES Act before the Senate Banking Committee. He's also expected to give the opening remarks at a Fed Listens, quote unquote, Fed Listens event on COVID-19. And so there's all these events that he's doing. These frequent appearances suggest, to me anyway, among other things, that the Fed doesn't want people to misunderstand what it's really doing, what it's doing from a policy perspective, and that its communication is an important part of hammering home what its policies are designed to do and not to do. So a lot of people are misinterpreting it, and I think they're really trying to get clarity and hammer home what their policies are supposed to do. And it looks like Powell is pointing out that there's this big discrepancy, right? This big discrepancy or this big miscommunication as to what people are expecting from the Fed and what the Fed itself is actually planning on doing. So first, what are people even expecting from the Fed? Well, like I said, if you've been watching my videos, like this recent one I did titled, "The Fed Just Bailed Out the Stock Market," you know that the Fed's been saying it will backstop the markets, right? So there's all these different programs that they have, including bond purchasing programs, the use of these SPVs I covered in that video, special purpose vehicles, and it appears that they're doing just that, right? Backstopping the market. In addition, when all this kind of first started happening, Chairman Jerome Powell told us repeatedly that the Fed would, quote unquote, do whatever it takes, quote unquote. He said QE to infinity, quantitative easing to infinity. He even used the word unlimited. So they told us what they were going to do, and they've been kind of doing it, right? So as a combination of the Fed's actions and the words that they've been saying, so they've been buying the bonds. They said they're going to buy the bonds. They said unlimited. They said all these things. It led to a lot of investor confidence, and even I would call it even overconfidence. And it appears that it's this overconfidence that's coming from the Fed's actions and statements. And so now it looks like Powell is basically trying to rein that back in, walk that back. He almost like he realizes what he said and done has created this false confidence. And so now he's out kind of on the path to tell everybody that, hey, don't be so overconfident. So in the latest biannual financial stability report, it was published on Friday, the Fed aims, among other things, to make clear that when you put money into the market, you risk losing that money. So he wants to let you know that risk is real. When you put money in the market, you risk losing that money. That's why we say never invest what you can't afford to lose. There is no explicit Fed backstop in the equity market. That's what he seems to be saying. The Fed said in their report, quote, asset prices remain vulnerable to significant declines should the pandemic worsen, the economic fallout prove more adverse, or financial system strains reemerge. End quote. There you have it. So he said right there that it's vulnerable to significant declines if the pandemic worsens. What more do you need? So they're warning, hey, we could have the second wave. And he's saying right there, the market could crash if it worsens. He also said that if the economic fallout is worse than they see, if it has more of a strain on the market. So there's a good chance it does. And he's kind of saying, if those things happen, the market's going to drop. We can't save it. That's what he's saying to me. He went on to say, quote, equity prices plunged as concern over the COVID-19 outbreak grew, reflecting declines in both investor appetite for risk and expected income, end quote. So again, he's just saying that as the investor appetite for risk is growing, it's just more and more risk that's being put onto the market. They also said, quote, equity prices relative to forecasts of corporate earnings also declined below the historical median. However, prices relative to earnings forecasts have risen since late March to levels seen before the outbreak. Prices have increased a fair bit from their trough, and analysts' firm-level earnings forecasts have fallen in response to the economic deterioration, end quote. Again, warning, warning, warning. The market seemed to be correcting. It's risen too fast. There's danger. Be careful. There's economic deterioration that could happen. And of course, I mean, this is correct, right? We know this, right? Price to earnings ratios. It's one of the ways that you value a stock. It's called a PE ratio. It's the price of the stock divided by the earnings, the PE ratio. And when you look at that ratio, then you kind of get an idea based off of how cheap or how expensive it is. And you look at it kind of like on a historical level. And so when you look at the PE ratios, they did appear cheap, at least for a moment. So when the market crashed back in early March, mid-March, March 11th, 12th, around there, to about April 6th, we saw the PE ratios dipping to about a 16 times multiplier, which was pretty cheap. But then right away, it seemed to bounce right back up. All right, so then by about April 9th, we saw the earnings get trimmed down, right? All of a sudden, the companies realized, oh, shoot, this is going to affect us more than we realized. So the earnings came down. So remember, there's a nominator and a denominator there. So you have the price and you have the earnings. So when they trimmed the earnings down, it pushed the PE ratios back up, and back again, they went back up into expensive territory. So in its report, the Fed also noted that the equity risk premium is the premium investors demand from equities over the risk-free securities is historically high. That's what they said. It's historically high, and general market conditions remain unfavorable. Since late March, volatility has come down, but it remains elevated relative to historic norms, and liquidity remains poor, the Fed said. In other words, the stock market continues to be risky. So in other words, the Fed and Chair Powell are trying to tell us that the Fed is not guaranteeing investors that stock will continue to rise. That's what they're saying to me. They're saying, hey, there's a lot of risk. You need to recognize it. We recognize it. We think that investors believe we're going to save them, and we're not. And basically, the Fed isn't going to guarantee that you're not going to lose money in stocks. That's what they're saying, right? And it seems to be, like I said, it's a big change in tune, because just a while ago, they were telling us unlimited and whatever it takes. and a couple months ago, 3-4 months ago. And he even justified high stock market valuations by pointing to low interest rates. But now the Fed is basically finding itself explaining why significantly lower stock prices might be in store, why people should be expecting it, why you and I should be expecting lower stock prices. And more broadly, we've been hearing from billionaires. I talked about this before, right? Lots of billionaires, lots of fund managers who are all basically saying the exact same thing, that stocks are overvalued and the risk of losing money in the stock market over the opportunity for returns, right? So it's always risk and reward. And we want to have more reward than risk, right? We're looking for asymmetric returns. And what they're saying is right now, there's more risk than reward. We want more reward than risk. So that's basically what's happening. Like I said, I recently did some videos on this. I recently did another one titled, Don't Believe What They Say, Watch What They Do. And in that video, I explained that even Warren Buffett is being super, super cautious right now. He's sitting on like $140 billion of cash because he doesn't know where to put it. And he said, quote, "You have to be careful about how you bet, simply because markets can do anything," end quote. That's right. And I talk about this all the time. That's why we need to practice proper asset allocation. That's why I developed what I teach is called the 4-pillar blueprint. There's 4 areas that we should be investing, because the smartest investors in the world are smart enough to know that they don't know. Just like what he said, you have to be careful how you bet, simply because markets can do anything. So you got to be careful out there, right? If the Fed is going to keep pumping up stocks, new all-time highs, okay, great. Could they do that? Sure, right? Anything is possible, and they might do that. But the Fed and Chair Powell sure seem to be going out of their way to discourage this type of thinking, right? They're definitely not trying to get people to go buy the market. He's saying it's dangerous. Warning, be careful. There's more risk than reward. And so if they're warning people, then we should at least be paying attention, right? And so to me, the warning message from the Fed is totally clear. And basically what they're saying is, there's no promises. So be alert, be ready for another market crash. If it's coming at the same time, we want to be positioned for the upside. And we do that through proper asset allocation, like I teach in the 4-pillar blueprint. I'll link to it in the description if you want to download. I have a free report that can teach you all of this. You can get absolutely for free. So I'll link to it down below. Hopefully you check that out. And that's all I got for you today. Leave me comments and let me know what you think. Is it risky or is it safe? Is the Fed going to backstop it, or are they going to let it go? Let me know in the comments down below. Give me a thumbs up on the video if you like it. If you don't like the video, that's okay. Give me a thumbs down. But let me know in the comments. I always want to hear from each one of you. I try to have a conversation with everybody. And that's all I got for you today. To your success. I'm out.